Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, but it cannot take care of itself. What's up this week? Today we're going to look at, of all things, Credit Suisse, the banking giant, the Swiss banking giant, the investment bank, the retail bank, and much more besides. Now I can sense a little bit what you're thinking. If this guy's going to tell me to buy shares in Credit Suisse, maybe I should run screaming from the office. After all, the bad news is out there. And what is the bad news? Well, I'll go through a little of the bad news. The market cap was about 85 billion 3-4 years ago. Now it's 44 billion. The Swiss franc is at an all-time high, and many of the salaries, all those high-priced Credit Suisse executives and employees, they probably don't feel as high priced as we're making them out to be, get paid in Swiss francs. Another downer. Give me more bad news. I got bad news for you. The Credit Suisse is the beneficiary of about 300 billion in banking deposits, yet it can, even if there's a float on those deposits, it really doesn't earn anything for them. So there's a lot of bad news out there. Why would anyone want to kind of delve into the shares of a banking giant trading below book value that only has problems? Think of the regulatory problems Credit Suisse has. Regulators in France, the United States, Germany, Spain, Italy, they all want a piece of Credit Suisse's hides, and there's been many provisions for that. One of the reasons that cash flow in the bank is almost dried up. And finally, and this is the kicker, it's a kick in a place you wouldn't want to be kicked. If you invested in Credit Suisse in 1996, which you can see here, put your money in over there, Credit Suisse 1996, and you rode this roller coaster right to the end, basically you're where you started. So don't tell me about Credit Suisse. I can hear many investors say, but there's some good news, and I want to go through it because the only time you want to invest in a share is when no one else wants to own that share. First of all, the PE is relatively low, 10, 11 times earnings. The yield is almost 3%. If you deposit your money with Credit Suisse, they'll pay you nothing. You deposit your money by owning its shares, say at $25 per share, not the 27 it's selling at now, you get almost 3% on your money. So 3%, and I think that's a secure dividend. Finally, and this is something that is a bit technical, but I think you've got to think about it. One of the great things about the shares of Credit Suisse is that the market values at almost nothing its private banking assets. And those assets are about $1.3 trillion. Meaning, if you take the valuation of Credit Suisse, the investment bank, the retail bank, the buildings, the investment advisory business, that will get you to the market cap of, say, $40 billion. Private bank, in effect, is there for free. And the private bank in a normalized market, what's normalized? There's no such thing as a normal market. In a normalized market, that might add another 20, 30 billion in market cap to Credit Suisse. So what's our hope? Our hope is that Credit Suisse, the worst of the news is out of the way. The fundamentals become stronger. The return on equity is painful. It's less than 5%, and no one's going to drive to the broker to buy this stock with it under 5%. Fee income from investment banking, fee income from private banking, reduced costs, a lower Swiss franc, higher interest rates on its interbank deposits. And you have a story there that instead of it being a $27 per share stock, the hope is it's in the $40 to $50 range. Well, that's all the time we have this week on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself.